Well, hello there folks, James here from TradingView. It's another week, another weekly roundup of the stories that you may have missed from stock world and crypto land. And I have to say, it's a particularly earnings heavy show this week with more quarterly reports than you can shake a large fist at. So we better get going. Meta earnings managed to make a comeback from last quarter's mishap. It's not all sunshine and rainbows, but apparently Facebook still has legs to it. So there's that. Meta shares shot up by 18% in extended trading on Wednesday, April 27th, after the platform reported an average but estimate beat in Q1. Meta topped on the bottom line with earnings per share of $2.72, but missed on the top with revenues that were up 7% to hit $27.9 billion, its slowest revenue growth since IPO. Facebook saw user growth once again, much to the relief of investors who were worried that the platform was so 2000s. Now that the young'uns had taken their ad revenue to TikTok, daily active users beat estimates and increased to 1.96 billion. But it's worth noting that Reality Labs, that's the Metaverse division, posted a $2.9 billion loss for Q1, 61% higher than last quarter's loss. Will the momentum continue? Current quarter guidance of 30 billion was lower than expected, and Meta says it's still contending with the war in Ukraine, which will affect global user count. The impact of Apple's privacy changes are also still lingering, but the brand reckons it has a competitive advantage in the advertising world. So let's see. Now, speaking of Twitter, Elon Musk's 11-day battle to buy one of the world's fave social media platforms finally culminated in a buyout. But is this just the start of the turbulence at Tweet HQ? Elon Musk is, of course, officially buying Twitter. Wow, it happened, the memes are lit, it's great. The board took Musk's first and best offer, selling the platform to the Techno King for $44 billion or $54.20 per share, despite originally deploying a poison pill to avoid such events. Why did they warm to the idea? Well, Musk took a tender offer to shareholders, meaning they could sell to him directly at a premium price. Perhaps they were worried that shareholders may take that offer if they rejected his, or maybe the $46.5 billion in financing that Elon received from Morgan Stanley showed them that he really meant business. So what happens now? Well, there's no real clarity on exactly how the transition will happen, but Elon has made it very clear that free speech is #1 on his priority list, as is sorting out Twitter's bot problem. The regulators have already got their eye on him, so really anything can happen from here. The Central African Republic will now accept Bitcoin as legal tender. Central African Republic, more like Decentral African Republic. On Wednesday, April 27th, the president of the country announced the government is going to regulate crypto usage and welcome Bitcoin as an accepted method of payment. The goals are to improve financial security for its citizens and innovate the economy. Now, El Salvador adopted Bitcoin last September, becoming the first country ever to do so. Adoption like this is still in its early days though. The International Monetary Fund isn't a fan of this country's adopting crypto deal, claiming it's increasing the risk of financial instability for nation states. So, don't sell the family farm for BTC because of the news. Adoption is almost always a positive for crypto, but the Central African Republic has a population of just 4.8 million, and only 11% of them have internet. Indeed, it is one of the poorest countries in the world according to the World Bank. Will crypto be able to invigorate its economy? We'll have to wait and see. Sales were down and inflation is up, all of which proved just slightly too much pressure for the big tech behemoth Amazon. Amazon sank by as much as 12.7% in extended trading on Thursday, April 28th, after reporting a mixed Q1, widely missing on the bottom with earnings per share of $7.56, but beating marginally on the top with revenues that were up 7% at $116 billion. Still, this marks Amazon's slowest growth since 2001 and its second straight quarter of single-digit growth. Inflation and higher wages were at fault for the disappointing numbers, according to Amazon anyway, and meant that its costs jumped by 5% of sales or $3 million every single hour. Yikes. The brand has also seen a dramatic drop in online sales, which were down nearly 4% from last year at $51 billion. On the plus side though, its cloud business is booming. Guidance left investors feeling on edge, worsened by the declining value of Amazon's Rivian stake, despite despite trying to offset rising costs by upping the price of Prime and adding a 5% surcharge for some US sellers, Q2 is forecast for revenue growth of around 3 to 7%, missing estimates. Seems like nobody, and we mean nobody, is safe in this current market. Is YouTube cancelled? Tech behemoth Alphabet wasn't quite as lucky as Microsoft when it came to their earnings report, dragged down into the dumps by declining ad revenue on its fave video platform. Shares sank nearly 10% in extended trading on Tuesday, April 26th, after hitting a near 9-month low in day trading. It came after the company's Q1 missed on both ends, reporting earnings per share of $24.62 on revenues of just over $68 billion. That represents a 23% growth year on year, a slowdown from 34% in the same period last year. What went wrong? In a nutshell, YouTube. Ad revenue on the platform came in at $6.87 billion, showing growth of 14%, but still lower than the $7.51 billion expected. It's not their fault though. Apparently YouTube's 2 billion users still spent time on the platform, but the war in Ukraine meant the larger European region has decreased their ad spend. And apparently the tough times are not over. Alphabet CFO Ruth Porat said the quarter will be even more challenging because of foreign exchange headwinds and its shutdown of operations in Russia. It can't have inspired big tech investors who had already sent the tech-heavy Nasdaq plummeting in 2022 lows last Tuesday in anticipation of the week's earnings reports. Apple's adequate quarter is somewhat ruined by an ominous warning from its CFO, who says supply constraints are waiting to bite it into its balance sheet. Shares fell nearly 4% in extended trading on Thursday, April 28th, despite the tech giant absolutely smashing fiscal Q2 estimates, reporting earnings per share of $1.52 on revenues that were up 8.6% to hit $97 billion. Amazon also took the opportunity to authorize $90 billion in new share buybacks. It boasted double-digit revenue growth in nearly all of its core segments, including services, Macs, and other products. People were kind of worried about iPhone sales after a bunch of production cuts hinted at low demand, but even that saw 5% growth, which means the iPhone 13 is doing pretty well. But Apple is going to get juiced in the July quarter, according to CFO Luca Maestri, who says there are several challenges ahead. Inflation means peeps aren't so keen to spend cash on tech, COVID in China means production shutdowns, and supply constraints are here to stay, all of which could hurt sales by as much as $8 billion. From Instagram to instant loss. Bored Ape Yacht Club holders fall victim to a phishing scam that sees over $30 million stolen in NFTs. Bored Ape Yacht Club had their Insta and Discord channels hacked on Monday, April 25th. The blue-ticked accounts were taken by the attackers, who sent the ApeCoin army to an unofficial link that mimicked an NFT airdrop run by Bored Ape Yacht Club. There, users were given a chance to mint land in the upcoming Other Side meta. But users got tripped up by a banana peel after getting told to link their MetaMask wallet to the scammer's wallet in order to take part in the airdrop. Once connected, users' wallets were basically an open door, and 91 NFTs were pinched within minutes. By floor price, the total stolen amassed to $13.7 million, but Yuga Labs reckons the market value will be less than that. Be careful out there, peeps. Even if it's coming from the horse's mouth, there's no such thing as a free lunch, especially when it comes to crypto. Big tech earnings are officially in session, and Microsoft manages to keep things upbeat, for now, with another bout of double-digit revenue growth. Shares surged as much as 7% in extended trading on Tuesday, April 26th, after a much-needed gain after April's 12% losses after smashing both ends in Q3. The computing giant boasted earnings per share of $2.22 on revenues that were up 18% year on year to hit $49.36 billion. It may have been the brand's smallest revenue beat since 2018, but come on, it's still impressive given this general winter of market discontent right now. There's a fair bit to celebrate, but its cloud business success probably tops the list. Azure, its cloud infrastructure business, saw revenue jump a whopping 46%, and its overall corporate cloud revenues rose 32%. That helped insulate Microsoft from weaknesses in games consoles and hardware sales, as well as a 10% increase in sales and marketing costs. The future is looking bright. Microsoft forecasts fiscal Q4 sales of up to $53.2 billion, just beating estimates, which include 100 million sales impact from the war in Ukraine and a production slowdown in China thanks to COVID. It was a positive start to earnings seasons. RBC analyst Risha Jaluria said this is a good bellwether for the rest of software. Gen Z are doing their best to keep Amex in good business, with investors focusing more on a lowered full-year outlook instead. Amex shares dropped 2.8% on Friday, April 22nd, despite the credit card company beating on both ends, with earnings per share of $2.73 on revenues that were up 29% year-on-year to hit $11.7 billion. Even after the drop, the stock has outperformed the broader market this year with nearly 10% gains. Hey there, big spender. First quarter revenue was driven largely by a 35% increase in global card spending, and Millennials and Gen Z led the way, seeing a 56% spike in spending from a year ago. Much of that came from travel, a segment that saw spending jump by 121% now that COVID is finally over, or almost over, and again led by the millennial cohort. Financial year outlook is where things took a turn. Not that it was necessarily bad news, it just wasn't as good as it could have been. Amex confirmed its financial year estimate for revenue growth of up to 20%, slightly missing estimates, but short-term investors were hoping that the credit card supplier would hike its outlook instead. Sorry folks, gonna have to wait till next time. Fintech giant Stripe is jumping headfirst into stablecoins, taking Twitter along for the ride. A new program from Stripe will let users get paid with crypto. The $95 billion payment company will now let certain merchants pay their sellers, freelancers, and content creators in USDC stablecoin, which is operated by Circle via the Polygon blockchain. Twitter is the first company to test out the new service. Users aren't already able to tip in Bitcoin, but now content creators who use Twitter's products like ticketed spaces and super follows will be able to receive their earnings in USD coin too. Is Stripe late to the party, however? This is the company's first big push into the crypto space since dropping Bitcoin 4 years ago, but in that time, major payments processors like Visa, MasterCard, and PayPal have all announced their own crypto moves. Stripe hopes to catch up though, with big plans to expand into other partnerships and cryptocurrencies. Okay folks, thank you very much for tuning in. I really hope you enjoyed the show, and if you did, please do feel free to give us a like or a subscribe, or you can sign up to our daily market coverage emails using the link in the description below. But until next week, wherever you are, whatever you're doing, always remember, look first, then lead.